In today's backdrop, 2024, we've experienced something that most people haven't in their entire life. A tightening of the credit cycle, raising of interest rates that has happened in a blink of an eye. And of course, over the last few weeks, the Fed has continued to have this, well, we're going to wait and we're going to see what happens attitude. But what does that mean for us in the small business world? We're not economists. Most of us didn't even go to business school, never mind take macroeconomics. But it does have a direct impact on your business. So I'll tell you, one place that it's going to start to hurt is if you don't have access to cash today because you don't have enough cash on the balance sheet. Now's the time to start looking at things like lines of credit. I know, I get it. With interest rates so high, you're probably saying to yourself, that's crazy, I can't afford the interest. But sometimes you're gonna need that access. So think about your line of credit as sort of like that line that you're gonna pull, that cord, right? That you may need it, you may not need it, but at least it's there in case you do need it. And you're gonna be prudent about it because that line of credit, the purpose of it is to, well, it's to support working capital, right? So if your customers pay a little late, but you still have to pay your employees, a line of credit is a great place to pull the cord. But in the tightening credit cycle, access to capital is going to get a little bit more difficult. It's not that, well, it's not like 15 years ago where there was no access, right? Where there wasn't capital available. There is capital available, but it's, well, the risk-adjusted interest rates look a lot different than they did 4 years ago, or even like 2 years ago. So you have to take that into consideration, right? You may not want to grow as fast because access to cash is going to cost you more money. So maybe you're going to pull back because having to service that debt, well, it gets a little expensive. So the first place you're going to see a tightening credit cycle is access to cash. It's going to get a little harder. The underwriting is going to be not as easy as it was back in 2015. But on the flip side, not having that access is not a good thing. Now, in the tightening credit cycle, the other thing that happens is, well, interest rates go up. For those of us that have had fixed rate loans that were put in place, say 3 years ago, you're probably going to be okay and you're probably going to avoid the cliff. For those of us that have fixed debt that's coming, well, it's coming due, needs to be refinanced, well, you're going to be refinancing in a totally new backdrop and it's going to cost more money. The other place where you're going to find a tightening credit cycle that could create risk for your business is for those of us that have SBA loans. If you've recently done an acquisition, for example, or if you had to go to the SBA for a small business loan, many of those loans, well, they tend to be variable rate. And many of them are actually pegged to prime. So maybe you're looking at prime +2. And in this rate environment, where the Fed funds rate is between 5.25% and 5.5%, well, you're looking at prime at 8.5, add 2 points to that, that's 10.5 points. Well, if you had to borrow $100,000 or $1 million, well, you know what it's going to look like. 10% of $1 million, it's a lot of money per year. So as you're thinking about your financial planning, well, you're also thinking about your business strategy. The reason you need capital is for growth, and it is to sustain your working capital. So there may have to be some sort of balance or a little bit of a pullback on what your growth expectations were because you may not be able to pass on those costs to your customers. So the tightening credit cycle isn't just about Wall Street. It actually impacts Main Street probably more profound than your typical Fortune 500 company. So as a small business owner, keep your eye on what's happening at the Fed. Chances are they're not going to raise rates, but they're also not going to decrease rates in 2024. The economy is obviously strong. They do have a dual mandate, full employment, and combating inflation.